Hello everyone and welcome back to my channel. In today's episode of Personal Finance Today, we are covering the topic 6 smart money moves to make in your 20s that can help you save money. If this topic sounds interesting to you or you would like to learn more about smart money habits, take a moment and subscribe to our channel. Now let's take a deep dive on these 6 smart money habits. Your decisions in your 20s might have a big impact on your financial future. Here are 6 money actions you may undertake to put yourself in a better financial position. Making wise financial decisions in your 20s can help you achieve long-term success. That means making a plan to pay off school debts, avoid credit card debt, save for a rainy day, and work toward broader goals like saving enough money for a down payment on a home. Taking charge of your finances when you're young, even if you're in a low-wage job, will make it easier to attain your goals in your 30s and beyond. Number 1. Make and stick to a budget. Making a budget is a crucial financial step that can help you organize your finances and keep track of how much money comes in and out of your bank account on a monthly basis. While creating a budget may appear to be a daunting task, there are various internet resources and apps that may assist you. Plus, once you have one, you've completed the majority of the work and may alter it when your spending habits or income change. It's critical to stay to your budget once you've created one. Check in with your budgeting goals on a regular basis to ensure you are not spending more than you can afford to repay. If you split spending with someone else, make sure you both have access to the budget and are held accountable to each other. Number 2. Take the time to improve your credit score. A strong credit score is essential for getting the greatest financial goods, such as credit cards and loans. Furthermore, the higher your credit score, the better conditions you'll be offered, potentially saving you thousands of dollars in interest over time. We always recommend you pay your balance on time and in full each month. One of the drawbacks of developing credit is that you must have some credit history to qualify for a credit card, and qualifying for a card without any credit history is difficult. One alternative is to become an authorized user on a credit card belonging to a family member or friend. You might also apply for a secured credit card, which functions similarly to a standard credit card but requires a deposit, usually $200. There are also a few choices, such as Experian Boost, that can help you improve your credit score without using a credit card. This is a free function that allows you to link your positive payment history for monthly utility, phone, and Netflix bills to your credit score, thereby improving your credit score. Once you have a credit card, the simplest method to increase your credit score is to use it frequently. Be conscious of your spending habits, pay at least the minimum amount due on time each month, and pay in whole whenever feasible. Number 3. Put money aside for a rainy day. Establishing an emergency fund to cover any unforeseen expenses, such as medical bills or auto repairs, is one of the smartest things you can do in your 20s. Your emergency fund can help you avoid taking out a loan or carrying a credit card balance, potentially saving you money on interest rates. Consider saving money in a high-yield savings account, such as Marcus by Goldman Sachs High Yield Online Savings or Ally Online Savings Account, when creating an emergency fund. These online accounts only enable you to withdraw money up to 6 times each month without incurring fees, which may decrease the temptation to withdraw money for non-emergencies. Professionals advocate placing 3 to 6 months' worth of spending into an emergency fund, but in the wake of the coronavirus outbreak and high unemployment rates, some financial experts are giving more practical advice about how much people should aim to save. Instead, after paying your bills, you should focus on saving as much as you can. It's fine to begin with a more modest goal. Saving $20 per week, about $3 per day, for a year comes up to $1,000, which is an excellent starting point. Number 4. Begin putting money away for retirement. It's never too early to start saving for retirement, and the sooner you start, the more money you can put toward your future. When you start your first full-time work, your company may provide you with a retirement account, such as a 401k, into which you can deposit a portion of each paycheck each pay period. Many businesses will also match your payments up to a specific amount, which is an excellent way to increase your savings. As a general rule, choose to save at least the same percentage as your employer's match. So, if they match up to 6% of your contribution each pay period, select to contribute 6% or more each pay period to your 401k. Employer-sponsored retirement accounts are beneficial, but you don't have to wait until you have a full-time job to begin saving for retirement. Roth IRAs are a terrific alternative to a 401k, and you can set up automatic transfers from each paycheck so you never miss a payment. Number 5. Get rid of your debt. If you have student loan or credit card debt, paying it off should be a top focus in your 20s. Having money owed to a lender might harm your credit by increasing your utilization rate, the percentage of credit you use, which can lead to a lower credit score. If you have a substantial amount of debt, lenders may consider you a high-risk borrower, which may limit your ability to qualify for other financial products. You'll end up paying a lot of money in interest charges the longer you hold debt, in addition to harming your credit score and qualification chances. Take the time to create a detailed debt payback plan that you can stick to. Consider how much money you can spend toward your debt each month after you've created a budget. According to some experts, you should set aside 20% of your take-home salary for debt repayment and savings. You might divert more of your income into debt repayment if you want to pay off your debt faster. If you have balances on several credit cards, you may want to explore debt consolidation. Debt consolidation can help you reduce the number of accounts you have to pay each month while also providing lower interest rates than a credit card. Number 6. Develop sound financial practices. Consider strategies to develop healthy money habits and be proactive with your cash while you're still in your 20s. Make it a practice to check the balances of your various accounts on a frequent basis. Switching to a no-fee checking account, such as the Capital One 360 checking account, or earning a competitive interest rate with a high-yield savings account, such as Marcus by Goldman Sachs High-Yield Online Savings, can help you avoid paying unnecessary monthly fees. Make sure you stay within your financial limits to prevent needless credit card debt and hefty interest rates. Consider optimizing your credit cards and opening a card with incentives that are suited to your spending habits. Hundreds of credit cards provide bonus benefits on groceries, gas, dining out, travel, and other purchases. Consider a simple flat-rate cash back card like the Citi Double Cash Card, which gives you the same amount of points on every purchase, 2% cash back, 1% on all eligible purchases and an additional 1% after you pay your credit card bill. You should be proactive and monitor any changes to your credit history in addition to saving money and collecting rewards. Early detection of fraud can save time and money in the long term, but it is difficult to do on your own. Signing up for a credit monitoring service can alert you to potential fraud before it happens, allowing you to take steps to protect your personal information. Because there are so many options, selected the best free and paid credit monitoring services so you can make an informed decision before signing up. If you plan to pay for a service, Identity Force Ultra Secure and Ultra Secure Plus Credit are our best selections, as they include notifications for changes to your credit reports from all 3 credit agencies, as well as up to $1 million in identity theft insurance. In conclusion, making wise financial decisions in your 20s can pay off in the long run and help you achieve financial success in the future. If you follow the 6 suggestions above, you can improve your credit score, become debt-free, and save money for retirement and other significant life events. Well, I hope you liked today's video. If you want to learn more about personal finance, please take a moment and subscribe to our channel. Until the next episode of Personal Finance Today, stay safe out there.